Well, welcome, my friend. It's been a while. We've been wanting to do this for quite some time, and I'm really excited for us to spend some time together and go through some trades. We've got 4 to cover today, some good, some bad, but from both results, we have a lot to learn. And I really like what you put together for some content for us to go over, and I'm really excited to see what happens today. If you're watching the recording afterwards, you can still drop comments and questions in the YouTube video, and you can also drop comments and questions in the Discord if you are a member of CFU. So let's dive in. Mo, do you want to give us a little introduction real quick and a little bit about yourself?
Yeah, absolutely. Thanks, first of all, the opportunity. It's nice to be able to put name to some of the faces. I'm pretty sure we'll get a few other people join in. Quick intro about myself. I've been investing for the last 20 odd years. Options has been a more recent phenomenon for me, maybe about 3 or 4 years ago. But I've been in the market for quite some time now. Buy and hold initially, but then started to delve into other forms of investing. So yeah, been at CFU for a little over a year and a half, I guess, maybe a couple of years. Yeah.
That's good. So you were a buy and hold long-term investor beforehand, likely built up a nice portfolio, saw some opportunity with selling and trading options, and it's going well for you. I can tell from some of the trades that you shared with me already. So I'm really excited to dive in. So with that, let's dive in.
Great. Awesome.
Okay, so the good trades, the bad trades, and what really matters. I love that tagline. It took me a little while to put that together. I was trying to do it the good, the bad, the ugly, and stuff, but here we are, and I'm really excited about this. So what I do like is always focus on those good trades that we have, right? And it's not always good trades. And some of the best lessons that we get to learn are actually from the bad trades. So let's kick things off with some of those wins and losses and some of the frameworks that we want to have built around us so we can come in with some structure and some clarity and hopefully some repeatability on that. Good? All right. So trade number 1, Micron. Let's dive in and let's do this. Sometimes you win money and you still lose the lesson. I love that. That was a good line you had there, Amal. So do you want to maybe step us through Micron?
Yeah, absolutely. So I'm going to talk about a couple of trades, as you mentioned, and both of them netted out positive. But that's basically what you can figure out the commonality between those two trades. Everything else was completely different. So here's what happened. As you know, MU has been on a rip for like quite a few weeks and months. The idea behind this, I'll explain the trade and then reserve the commentary later. I went into the trade on Jan 21st with the intent to like buy long puts and hedge against those long puts with another trade. I'll get to that later, but I just went with the puts. I bought 4 of them on the same day. Micron was trading at around 388, and all those 4 trades were pretty much at around 70 delta. Pretty risky from a pretty capital intensive, as you can imagine.
Right.
And then Micron maybe traded a little bit sideways for a few days, and then it just took off. The next thing you know is it's hitting 450 and you don't have a hedge. And so it was too late to put a hedge. So usually when I go into these trades is maybe buy 1 or 2 long calls or long puts and have a hedge against that so that you can like adjust and maybe sell one of them and get out of the trade if it doesn't go your way. Unfortunately, for some reasons, I wasn't able to put the hedge, which meant like after 2 days, it was just no way you can salvage this trade. I bought a few of these long puts again, reduced a little bit of my drawdown, but then they were like pretty short term. And so what ended up happening by 4th of Feb, which is like just recently, Micron dipped, which is what I was expecting. And I was able to get out of the trade exactly at the same price. MU was trading at 388. So if you look at it, I netted out around 1,300 or so for those four puts. First of all,
so it ended up being profitable, but kind of almost by luck, I think is kind of what you're saying, because this is around the area that you bought the original 470 puts, and then it rallied hard up to the 450. Like you were saying, like by that time you were really in a loss position. It was difficult to recover. You did buy some more of those. How many more did you buy? Because it was 4 at the beginning.
Yeah, I got around like a couple of them at like 420, 430. And then as it took a dip, I just booked the profits. So overall, like if you look at the dip right before it went up again, which is, yeah, that's the time when I sold some of those additional puts that I'd bought. But again, the trade went against me again. The Another sort of thing that I should have done here differently was this was a 6-month expiry, right? Not great from a capital intensive trade perspective. I would have loved at least 12 to 18 months, which would have been a decent way to like hedge against that and like bring down the losses. But I think the duration also played a big part. Not ideal.
If we go to the next slide that you had on this, you highlighted some of the points as to why some of your kind of takeaway lessons that you had from it.
Yeah, exactly. I summarized a couple of them, but too many contracts, right? 4 contracts at 70 delta is just way too much for one trade. I usually don't go that deep in terms of my buying either the puts or the calls, and the high delta also meant that it was an extremely poor risk reward, which actually turned that way.
The short duration, too many contracts. This is one of the most common questions we get at CFU is how much should I allocate to trading or to dealing with options? How many contracts should I be trading in these? And like my recommend, like I'm not saying this is for you, Amol. This is more for just like everyone. So when you start with CFU and you're following some of the trades that we're doing, please start with one contract. Even if I'd rather have you make like $50 or $75 on a one contract trade and get used to how it works and you just get a feel for what's it like to trade options instead of jumping in. This was a long time ago, like, probably 2 years ago, we were trading McDonald's and we had a new member join in. And I think we were doing a bearish trade on McDonald's and we were doing call credit spread. And he went in and did 10 contracts and he was like excited and really enthusiastic about it. And then luckily the trade ended up being 100% profit. We didn't have to roll or anything. It just continued on the way that we wanted it to. But that has always stuck with me because that was way too much for somebody who's brand new to be jumping in. And that's kind of mentally how I kind of rationalize it. Please start with one contract. And as you get going, you'll find out, okay, what this feels like, and you'll be able to allocate correctly. So I guess I'm putting the question over to you, MO. How much should I be allocating to trades?
My typical non-written rule is like 20%. I don't go about 20% for any of my single trade, which again might be a little bit on the upper side. Like most people would go about 5 to 10%.
Just narrow in on that with the 20%. So with this one here, 4 contracts with Micron, that's your 20% rule applies to this rule that you would not do more than 20% on the Micron trade. Like that's an allocation. Like you're not talking about 20% for option trading. You're talking 20% for one trade.
Yes, 20% for one trade. Exactly.
Yeah. Gotcha. Okay.
Yeah, exactly.
And I think there's, and even with that, there's so many different ways of looking at it. Like, for example, today we opened up a covered call on NVIDIA. And that was, I'm just using that as I have a position in NVIDIA. I'm very bullish on NVIDIA. And so I'm okay to put a covered call on it. It's almost a no brainer. So, but NVIDIA, I think allocates about 7% of my portfolio, and that I'm totally fine with that. In fact, I'm okay to go even higher on that.
Yeah.
But I guess like if Micron was 20% of your portfolio in terms of a holding on like long term, you could sell covered calls on that, no problem, I think, right?
Yeah, I agree. Yeah, absolutely.
Just the high delta trade. Can you explain the relationship between high delta and capital intensity?
Yeah, I mean, typically when you have high delta, the rationale is basically that you need very little stock movement for you to get into profitability. I mean, the other way also works. It's also true where the stock dips, you are in loss. But one of the things that I love about high delta trades is like if you get into good companies, and if you're like bullish on them, let's say you buy high delta long calls, there is a good chance that the trade will go in your favor unless it's there's some bad news that really comes along in the next few weeks and months. So there is a good chance for you to get out of those trades quickly, which is what I like about high delta. Of course, as I said, there's a huge downside, but the idea is like you have high conviction about these companies, and that's why you are getting into high delta as opposed to like outright buying maybe 300 shares of a company.
Right. Yeah, no, that makes a lot of sense. Okay, let's go on to the next trade. The next trade, not backwards, forwards, is to do with a cruise line, Royal Caribbean. Okay, step us through Royal Caribbean.
Yeah, this is a trade roughly around the same time period, like end of January. And this is how I would love to do all my trades. Why did I go into this trade? Seemed a lot overbought after the earnings were a double beat. This was right on the day RCL released their earnings. It touched 350. I've been tracking RCL in terms of the support and resistance levels, and I was comfortable buying a put at that level. The good part I did right on that day was also to sell a CSP with IV and good premiums. It made a lot of sense to hedge against the long put.
Okay, so this is just a recent trade, so we can dive into this. This was done on January 29.
Yep.
Okay, so we can dive in, and we got earnings and everything that we can pull up here. Okay, so on January 29, you saw the nice big upsurge, right? This is when you entered in, so they beat on earnings. They beat, let's see, I mean, the earnings per share was kind of essentially even. They didn't really go much anywhere.
Yeah.
That's a beat, but I guess, I don't know, it's more like an expectation. But the revenue on the company kind of stayed flat too. So, I mean, between the two of them, I guess the estimate was kind of just bang on where they were going. Did they talk about the tourist industry or something?
Yeah, I think the guidance was pretty upbeat. Plus, what I've seen is RCL is a highly cyclical stock. So it will like go up and down during the right seasons and or after earnings. So this was one of those days where the stock popped and I was pretty comfortable buying a put at that level. Yeah.
Gotcha. Okay, great. So then this is a bit of a different strategy used. This is like a diagonal put spread? So
Yeah,
it's almost like a poor man's covered call, but on the opposite side, on the put side?
Exactly. That's how I look at it. This is exactly opposite of PMCC, where you buy a put and sell a CSP. So the same net effect, but you are basically bearish on the stock and you look at the stock dipping in the near future. So another thing that I usually do with these trades is I go long in terms of duration on the long side and have a short-term CSP against it, so that I can quickly get back in terms of the theta decay work in my favor if the stock keeps going up, and it will offset any losses in the near term while the stock dips in probably in the near future.
Okay. All right. So that strategy that you just explained, that's not this here with Royal Caribbean. What you're explaining is that's kind of like your favorite way to enter a trade.
Yeah. I mean, that's one of the two. I will either go with the PMCC or the reverse of the PMCC.
I put this in through option strat, and it said put spread.
Okay.
Which technically that is what a poor man's covered call is a diagonal call spread, because you're buying further out a longer dated long call option, and then you're selling calls against it as you go forward towards that in time. And I think we all can understand that very well. But this is almost like a mind bend where you're buying the longer term dated put, and then you're selling CSPs.
Yep.
As you go towards it. Yeah, it's kind of crazy.
Yeah.
Good. Okay, so with this one here, so you bought this 10 minutes to the market close. You bought at 7,800. You sold at 500. The 500 is the nearer term, or the February 6th CSP. And then you got this long September 410 put. And then just the next day, this was 10 minutes before the market closed, and the next day, market open, the stock price dips down to 325. We can bring the chart back here.
Yep.
So the stock dipped down here, like this.
Exactly. I mean, it worked. I mean, I was expecting it to dip at some point because it's shot up a lot, but the very next day was a pleasant surprise.
Oh, yeah. That's a really great. Yeah. Excellent. Okay. So with this, if I understood it correctly, you were able to sell the long put for 91.25.
Yep.
But you still had to cover off and close the short put, which because it had dipped, it was a little bit getting close to the money. You said it was, actually it was in the money, right? Because it was down to 325.
Yes.
Yeah. Okay. But the delta or the price appreciation on your long put accelerated faster than the short put. And then you were able to get a 620 gain on that, which is a 8% return on capital.
Exactly. And that's also one of the thing that I was talking about, like high delta trades will give you that push and like you'll be able to close out the trade. Another way I could have done this trade is like just sold off the put and just kept rolling the short side. But I wouldn't, I would love to close out and then go on to the next opportunity rather than go into this rolling, especially when the stock has moved so much.
That's a good one for sure. Okay. Next one. You're going to ask me questions as we go through this, and let's see what lessons we can learn from this. So if you're watching and listening, feel free to drop comments and questions in the comment bar there for YouTube. We'll answer them here live. Again, afterwards, you can always do the same either in the Discord or on the YouTube channel, and we'll answer them there as well. Okay, let's get into it. JP Morgan Chase. Okay, so this is my bread and butter trade. I love this. It's super easy. It's just a classic, nice, well-oiled machine for generating income. So this is a put credit spread. We sold the 295. I bought the 290, and we got $140 in premium. The max risk on this was $360. So this is a 5-point PCS, and we were able to get $140 credit up front, which makes the risk $360. At around this time, JP Morgan Chase was trading at about $302. So we got the chart here. This is what the chart was looking at. Sorry, this is what the chart was looking like right as we got into the trade here. So this is the moment we posted the trade. This is the chart that we shared actually in the Discord. What you can see is there's a bullish trend on JPM as it goes. It's slowly making higher lows and higher highs. Okay, we can see that here as it goes up, comes down, and then it comes up, and then it does a break of structure. That often occurs when it's able to exceed the neckline that it has here, and it goes above, and then it comes down below, comes up above again, it breaks the structure, makes it reaches for a higher high. As it continues to do this, this is just an easy pattern to see how it's going, almost like a saw pattern. If you look like at a table saw upside down, it's exactly like the pattern it's making here. So when it got back down here, right at the trend line, that was a good opportunity to sell this PCS. And so we were able to come in at around this time here, this area here, whereas that's the green zone. And we're able to kind of put the put credit spread right around there. So why do we like this? Again, the bullish trend. There's also a seasonal tailwind. So with financial stocks, especially JPM, this time of year during Q1 is typically a very positive time for financial stocks. So JPM has a very good historical bullish tailwind that it seems to find around this time of year. And it's got the trend. There's no earnings risk. If you look down here below, they had just reported earnings, which is likely the reason for this bit of pullback here. And we were able to do a real short time decay on this one too. So it was all looking very, very positive for us. Any thoughts or comments here, Emil?
Yeah, so I have a general question about these trades. I see you do a lot of these spreads. What is your general approach or strategy when picking up, like arriving at, okay, let's go with JPM and let's go with credit put spread, or like, what are the 3 or 4 key things that you look at?
So this one here, so I like to look for the seasonal trends. So this is coming in on the weekly income system that we have here at CFU. If you go into our Discord channel up on the left-hand side, you can scroll down, it says weekly income there. And so for this, we just go through and we look for cyclical stocks that have a very strong seasonal pattern. That's a very strong governance model that we have for this. So financials typically do really well at this time of year. And so this was just such an easy pattern to recognize. So you just go through your financial stocks, Bank of America, JPM, and pick them out and say, JPM's just an easy name to pick. Like, even if it goes wrong on us, we know how we can easily roll. It's going to be very liquid. It's going to have a very healthy options market. And they have a figurehead with Jamie Dimon that's always So I love JPM. I will any time of year. I guess that goes against the seasonal trend, but like this is a great time to jump in on JPM. And then just the pattern here, which is easy to get in. And so I try to go as near term as possible, like 1 or 2 months is usually how far out we have to go, sometimes even 3 months to get enough credit and also stay far enough out of the money. In a typical market, these trades will always do very, very well. So a typical market being like the average S&P 500 doing a 10%, 12%, 8% return a year. Where we do struggle is when we have a absolute disaster of a market and it's getting very difficult to predict how the market's going to behave. So then you also asked why PCS on this. Well, the format of the weekly income system is typically towards PCS, so put credit spreads. We do it sometimes flip and go call credit spread, but it's not typically the modus operandi of the weekly income system. So we're typically doing PCS. It's a very low risk trade. We are hedged to the bottom, and we're able to get some decent premium out of it. Did I answer the question?
No, absolutely. Yeah. And
Yeah.
just a quick follow-up on that. Does volatility of the stock play a role in the way you choose some of these trades?
So we're not going to be doing these on extreme high beta stocks or on meme stocks. These are usually going to be done on well-established components of the S&P 500. That's a filter that I have on the screener that looks for seasonal trends and stocks that we should be trading on. Also with that comes, we need to have enough value or market cap in the stock because that's when we're able to get enough premium from the one contract. It's really difficult to get this level of premium out of a SoFi trade. It's too low value, and I have to take SoFi is trading at around $20 now. I got to sell like the 19, and then I gotta buy the 17. Like I can't go very far down because the hedge just, you know what I mean? Like I just can't get enough premium, enough return. Yeah. So it's usually going to be like the higher valued stocks.
Yep, makes sense.
Okay, so how did this one go? So this was very easy. This actually did better than we wanted it to. So we were out of this in 11 days, which is not typical for weekly income. We usually need to have around 60 days. So this was a real nice, tip of the hat for the weekly income system. 11 days, zero drama, boring is beautiful. We got in, time decay happened. We did have some price appreciation on JPM. It rose up nicely, and we were able to close it out very early and book our profit on it. Yeah, so this is zoomed in a little bit on that chart. This is what we were looking at when we got in. Remember, this is that trend line, and this would have been the time that we got in on January 21st. And so we did have some negative experience at the very beginning. It did go in on the money for us. That was okay. We did have the long put to help us and hedge the trade, and then it took off. And as it went through here, this is when we were able to close it off here. 11 days, then we're out. So nice and easy on that one. Once it crossed over the 50-day moving average, and especially on a stock like JPM, where there's so many analysts and traders that are looking at it every day, these stocks really tend to respect some of the technicals that are being looked at every day. So when it crosses 50-day moving average, they're all going to be like, okay, time to buy JPM. And it's like, well, whatever. You sold down here, then you buy back here, whatever. Okay. All right, let's go to the next one. This is a Kyle trade. This is Colgate Palmolive, I think it's called, isn't it? Colgate. I just know it's Colgate, but I don't know.
Colgate
Got
Palmolive.
the Palmolive brand in there too. So I think we're all used to Colgate. It's hilarious. I don't know. Do you know Spanish at all?
No.
No. Okay. So in Spanish, this is actually kind of a fun little thing. So Colgate, when they went to go down to Latin America, they wanted to go down to Mexico and all these other Spanish speaking countries. They put their brand name on toothpaste and all the other household items. Colgate actually has a very distinct meaning in Spanish. It means colgate, which means hang yourself. So it literally means colgate. It means like put a noose around your neck and hang yourself. So yeah, it didn't do too well. So down in Latin America, they have to change their brand name. It can't be Colgate. So kind of fun little thing you learn with marketing and stuff. And you go into other countries, sometimes your brand doesn't resonate the way that it does back home. Okay, Kyle, I wish he was here online with us, but I'm going to step it through because I kind of get where he's going with it. Kyle is looking at the market as he's definitely looking at it as being overbought on the upside, especially on tech and AI. If you're familiar with Kyle and you've been with us for over 6 months, he even has a red candle theory, and that's gone viral within CFUC. Do you want to maybe give a brief overview of what?
I'm not
candle
quite
is?
for that, but yeah, I know for it for sure.
Yeah, everyone knows it. Okay, I'll bring it over real quick. We do have a YouTube short on it because he explained it to us live one day. Let's go SPX. Okay, that's just a trade that we had that turned out the way that we wanted it to. Okay, if we go back, it's October 10th, right? Is when we got the big red candle, 1010. Right, that's 2024. Oh, we're all the way up here. This right here, this is the big red candle. And we're using this as an indicator, and it could take months to play out, but this was a distribution indicator here as a really strong wide body candle to the downside. And we've seen kind of a consolidation in and around this level. Yes, the market's kind of almost on its last wheels trying to push and see what we can get. But as we're getting up into this red zone here, we're getting a lot of highs where as soon as we get up into this area, it sells off very quickly, almost to come right back down. So this was a huge indicator to us that big institutions, funds, pensions, whoever are looking at this as a selling opportunity in general, and they're going to take time to distribute or to sell off some of their shares and holdings. If they did it too quickly, they wouldn't get overall as good of an exit price as if they slowly let retail investors buy their shares from them. So that's the big red candle right here. And then we had a duplicate of it right here on November 20th. So this is kind of our thesis that we're looking at for the market going forward, is that we have this overall, there's been some bearish indicators that we just need to be aware of. And so when we go forward and we look at AI, big tech names, we want to start maybe not trading them bullish as much as we have in the past. We want to rotate and go into other sectors. Colgate definitely fits that in terms of another sector besides tech and AI. We all know what Colgate does: toothpaste, diapers, all the household items. When it got down into here, it started to form a foundation and a support level. We were able to drag down the 50-day moving average into this zone here. And then right around here started to pump up, and it broke structure here. It broke the neckline that it had established before and started to pump up and up. And then it broke the next trend line right here. And so this was an indicator for Kyle. And he said, let's jump in on this. Let's buy the 85 call option. After we crossed the 200-day moving average here, which is likely one of the indicators he was looking for, it was all green light for Colgate. All of the narratives, everything was lining up just nicely for it. And it started to pump. And if you had bought down in here when it was below the 50-day moving average and took this buy signal, you would have sold at this indicator here with the X. However, this is just barely after we got in. And so we wanted to take a little bit of risk here and continue to go with the trade. And once it did this one massive jump up, we got out of it. Now, in hindsight, looking at it, well, maybe we should have waited a couple more days and we could have gotten into this area here and really significantly increased our returns. But at this point here, we got to fill at 720. We're able to get out at 1050.
Yeah.
It's not a bad trade. We're getting some good profit on this one here. So that was a $330 trade. Yeah. So, Amol, did you participate in this one?
No, I did not actually. It's a
Oh.
very interesting one for sure.
It's definitely like, you look at it where just days before it was trading at this $75, $74 range. And then just days later, like maybe two and a half weeks later, it's up to $94, puts on $20 in such a short time. There's lots of lessons to be learned off this one.
Absolutely. And this is a great example of watching the right levels, the volume, all of those things matter over here, right?
Yes. Yeah. And good point there with volume. I didn't put volume on this chart just because sometimes when you do that, it makes it very cluttered. So sometimes when we're getting these ready for screenshots and presentations, we turn those off and just go right down to the very basic stuff so that the chart itself can highlight itself. There likely was a lot of volume down here. These little wicks here, where it's kind of almost like a sideways candle, if you will, these are fair value gaps. This is when the market is willing to take any price. So they are willing to pay any price, and that often called, they're slapping the ask. They're just going market. I don't care what the price is. I need to buy 2,000 shares or 10,000 shares of Colgate. I'll pay the price. And so that's when it rips. And it's just a continuance of people being willing to pay the ask. And that creates a fair value gap. Because if they were going just a little bit slower and weren't so urgent on filling their orders, they could have used limit orders and maybe gotten a better price. But they're willing to pay the upside because they see that in the long term, maybe even days later, that it's going to be even higher. It's going to be $95, $100. And so seeing these wicks of fair value gaps is a very good indicator that institutions are paying this
Yeah.
and
Just
pushing the stock
curious,
up.
just curious, was this like an all-time high for Colgate, or like zooming out of this chart? Was it like doing it? Okay. I mean,
Yeah, good question. I don't know. Let's find out. Hey, look at that, man. Like rip.
there you go. Oh, almost.
No.
Nope.
So it can go up to 104. Like, look at this, right? Imagine selling covered calls through here. Like, that's nice.
Yeah. And to your earlier point, you exited out of this trade, getting decent profit. The reason why I asked this is like, once you go at above all-time high, it's a clean slate. There's literally nothing that you can like benchmark against to like say, hey, should I get out now? Couple of weeks later, you can just get a really nasty downward side swing as well. So interesting.
Yeah, it's also too, like, I love the question. So would you rather buy a stock at an all-time high or would you rather buy a stock at an all-time low?
That's a great question. I would personally be very reluctant to buy a stock at all-time high. Maybe it's just my psychology. I would be much more in tune. If I look at the fundamentals of the company and like see there is some value there and it's oversold, I will be like more than inclined to buy at the lows.
Yeah, that makes sense. Yeah, it kind of makes sense. A lot of investors intuitively are drawn to that. I think the studies show that if you buy stocks at all-time highs, every time they do make an all-time high, you'll actually do better performance-wise than continually looking for all-time lows and buying those instead. So it's kind of creepy. It's kind of crazy. A stock hitting an all-time high is actually a bullish indicator, but it always feels bad when using it as an indicator. Then it drops after that. You're like, man, if I just would have waited a couple days, I could have gotten a better price.
Yeah.
But it's just, yeah, I'm with you too. Like the psychology is like, I don't know, like especially with silver, right? When it was making its run and it's like at 120, it's like, you really want to be buying that all-time high? Huh?
Yeah, exactly. Yeah.
Okay, so YCL, I think we already kind of went through this sector rotation. It had a technical breakout, which we just talked about and showed. It had earnings confirmation. So this one here, this is the earnings that it had, and we can bring that across over, and that could have been a very strong. Yeah, so it did fantastic, right? So it beat on the earnings and it beat on the top line, bringing in more revenue than what was expected and also more profit, so they can distribute more dividends. And so here's their dividend information down here in the bottom right on Trading Views. They have a yield of 2%. So that's also a really strong driver for dividend stocks, right? When they have a nice big earnings report like this, the institutions, the funds, the pensions will look at this and say, well, they do like a 75% distribution or payout ratio for the stock. And so if they're earning more, they're going to be paying out more in dividends. And then also too with that narrative of the AI sector rotation. Okay, so that was another one. And then, yes, the mega cap divergence. And this is getting to like let's not put all of our eggs into NVIDIA. Let's maybe put something into Colgate as an example. And just even saying that sounds like, why would you do that? Why would you sell NVIDIA and then buy Colgate? Like, how boring can you be? Is that where we're going?
Yeah.
It doesn't matter. If you're making money, you're making money. What does it matter if it's Colgate or NVIDIA? At the end of the day, the goal is to invest and increase your buying power and income. All right, let's do some comparisons and some takeaways. Let's pull back and compare these trades. I love this image. I was like, man, that's a really good image. I want to make sure we keep that and use that. So the black and the white, the good and the bad. Let's see how it goes. So these are all the trades stacked up back to back. Let's go through Micron. Just a real quick summary. What was the lesson that you learned from that one?
Always hedge, right? Don't get into these buying option kind of trades without having a plan. If you fail to plan, then you plan to fail essentially, right? And that was a classic example of how nasty it could have gone. There was nothing stopping MU going beyond 450, 500, and I would have eventually run out of time. So always hedge. That's the big learning. And position size. 4 was too many contracts for that kind of a trade.
That's true. Yeah. And like when that narrative of Micron was happening in terms of why it was going up, so strong and with such conviction. It was that was scary to like have a bearish trade against that when they're talking about memory shortages.
And the momentum was in favor of it that was very, very unlikely that it would have.
We need to do like a market psychology live stream and just kind of go through like mentally, how do we cope and stay calm and confident in our trades as we go forward and when they oftentimes don't go the way that we wanted. Okay, Royal Caribbean, what was your lesson that you wanted to take from that one?
I think that was much like how I would love to have most of my trades, get in, out overnight. But that's not going to happen. But at least from a trade structure, I think it was in terms of sizing. It's one contract. I would have loved to do 2 contracts because then, as I said, I could then sell one of them and then just keep the other one running. But one contract, small position, hedged appropriately with a CSP with high premium. Love it. Could have played it in so many different ways. Could have just extended the trade, kept it going, kept the CSP rolling, and all of those stuff. So could have given a lot of options. So love that trade.
Nice. With the JP Morgan, it's to have a system. So it's just confirmation that having a system and having a framework for entering a trade is very beneficial. Having it be high probability, very repeatable, and knowing the structure. And I'll also build on that too. I'll say having a plan B. I think, Amol, you know that I can, even if that goes against me, I have my plan B. I know how to repair it and make it into profit into the future there. So that really helps me out, like as I'm entering the trade, to be like, okay, well, it's JP Morgan. There's good confirmation of the structure, nice trend line. We're in a good season or time of year to be in this stock. Let's enter it in. And then even if we're wrong, it's not going to be a disaster. And we do know how to roll this and manage our risk appropriately. With Colgate, the lesson that I learned, like me personally on this one, was follow Kyle. I don't know where this guy gets the stock trader's almanac that he's using. Like, where's his crystal ball? Where is his like 8 ball that he's got? And it's like, he just shakes it up. Colgate. Yes, this makes sense. Like, where does he find these things?
Yeah.
And,
I mean, that was a classic technical trade that you can get. Like, you can't get a more classic trade looking at all the possibilities there. So
it totally is. And I think I've talked with him privately and just kind of like DM, like, hey, dude, good work on Intel, good work on Colgate. And he even did like Budweiser, like like incredible. He's got, and so I just said like, well done. Like, thanks for putting pocket in my personal account or putting money in my pocket, like my own personal account. Thank you very much. And he said, I'm a technical guy. And I know guys think that technical analysis doesn't work, but for me, it does. And I love technical analysis. I'm going to use that every single day. And he loves just simple trades. He just reads the chart. He's like, okay, they're forming a bottom or they're forming a top. I'm going to enter in today, right? When we had that, we're doing really well on the SPX or the SP 500. It's a good time to be putting in a bearish trade on the S&P. And so he put for May, a nice hedge on the S&P 500, and it's got a lot of safety to the upside, which I love how his mind works and stuff. So it's really good. If you're a current member, CFU, definitely follow and put notifications or alerts on Kyle's trades. And if you think he's doing too much margin or too much buying power, you can always go and follow his 10K trades. He has a $10,000 account. So he uses that in trades and he's already got it up to 13,000 overall. So just little trades here and there, and he's able to get that up. So that's the lesson that I learned is follow Kyle. Whenever he does a trade, just do it. It's good. This guy does his homework. He knows how to read charts, and odds are he's going to do well. And then I guess just with that, if I could just add just conviction with conviction trade. So, when you're going in, have high conviction. And with JP Morgan, I also had that given the framework that I was looking at. And just have good sizing and have a good thesis as to why it should play out the way you want and have an exit. I think maybe that's probably the most difficult part with Kyle's trades is because suddenly they will work and they'll give you a lot of money suddenly. And you'll be tempted to be like, now that we got it right, let's just let it run. Just like we saw with the CL or the Colgate trade. But when he gets out, that's a time for you to get out too. Because once he gets out, he's not looking at that trade anymore. He's on to the next one. So if you don't follow and get out, You're kind of on your own, but you can pay off.
Now you need to turn on your alerts for Discord for sure when you're following all these trades. It's, as you said, you might get stuck with a trade for like weeks if you don't get it out right on that day, maybe a few hours after that.
Exactly. And so, yeah, like definitely when you join CFU, and you're in there and the Discord looks really busy. It's really chatty. We have over 1,000 members. I think last count, we're at 1,047 traders that are in CFU and trading with us. It's really chatty. So that's okay. You can mute some of the channels, but you always want to be putting notifications on the trade alerts, because that's where you're going to get the bulk of your value and being able to know what trades to get into and to get out of. All right, last one here. If you're new or you're not part of CFU, this is your opportunity to come in for free. You can check us out. If you go to joincfu.com/starter kit, up here's the URL. We'll give you for free an ebook, PDF guide for generating weekly income. We'll give you one of our high probability trade scanners, and also access to our Discord community where you can join in, jump in, and ask us questions about options or anything that you need to do to get started. Maybe you want to know, which brokerage should I use? What option level do I have to have? How much money do I need to start? We can answer all those questions to get you started in becoming successful in option trading. If you're a stock trader and you want to get into options like Amol, this is a great option to start that journey, and so you can start it for free. Now, of course, yes, when you jump in, you're not going to be getting our premium trade alerts. You're not going to be getting all of the true value with CFU. That's reserved for our paying subscribers. And so over time, as you see some of the results that we do, we'd really see you come and join us in the premium level and be able to get full value and full results of CFU. Anything else to add on that one, Amol?
No, that's good. I think you said it all. Thanks.
Awesome. And is that the last slide? No, there is one more slide. It's question and answer, but we only have 2 people online. So this is your last chance to ask us a question. The image here has like a whole group of people around you. I'm all asking you questions. I don't know if that's actually going to happen here. We've got 2 people watching.
We can always take it later.
Yeah. So if you do have, after watching this video and the recording, you can ask us questions in the YouTube channel, or you can also ask us questions in the Discord channels. Thanks. I'll see you next week.
Perfect.